Hey, what's going on, everyone? Welcome back. Today, I want to talk about one of the harder problems of investing, essentially the essence of investing, basically when to get in and when to get out. So, I'm going to talk about a couple different indicators and tools you can use to lock in the profits. So, sit back, relax, and let's get it. All right, everyone, welcome back. My name is Zach, and as always, I'm your host here at the Divine Dividend. Today, we're talking about the charts. So, this is going to be considered technical analysis, all right? But if you look at something like this is just the line chart for the S&P 500 as a whole. Okay, lots of ups, lots of downs, a couple big downs, all right? But how do we know if it's about to go up or how do we know if it's about to go down? So these are some of the tools we're going to talk about, and you'll see a different way to look at the chart that might give you a little bit of a better idea, all right? All right, so a couple things you'll notice right off the bat is one, we are not looking at the S&P as a whole anymore. For this example, we're going to look at Inovio. Okay, it's a pharmaceutical company, biotech. It's something that moves a lot. It's got a lot of volatility, so it's going to be perfect for this example. The other thing you'll notice right off the bat is instead of the lines, we're using candlesticks. Okay, so if you're not familiar with these, not a big deal. They're actually pretty easy to learn. The green ones, obviously it went up during that time, and the red ones it went down during that time. So the time frame we're using right now on this is the 1 hour. So every little stick represents 1 hour. And if, like the solid body part, so this is actually called the candle. That's, if it's red, this is where the candle started for that hour, and then this is where it ended. And then this little line at the top, that's called a wick. It's down here at the bottom too, okay? So this was the highest it was during that time frame, and this little one down here, this is the lowest it was during that time frame, okay? So, and then just like a green one, that means it started the hour at the bottom and ended the hour at the top. This was the highest it was at one point, and then down here, this was the lowest it was at one point. Okay, so that's how candlesticks work for the most part. And then over here on the left, you have your price of Inovio, and down here on the bottom, this is just the time frame. Okay, so the stock market's open for 7 hours a day. There's going to be 7 candles for each day. Okay, so one of the most important and easiest things you can use is finding out the levels of resistance and support. So what does this mean? So resistance means like there's a price point over here, okay? And I'll just mark the different levels by these black lines. So resistance would be there's a price point and the stock wants to get above it, but it can't. So as you can see right here, this line is sitting at about $14.25. You can see these different wicks get so close to it, all right, but they just can't quite get over it. There's a resistance there. So that means people are probably selling right when it gets to about this point. They either bought it a lot lower, somewhere down here, and then a lot of people, for whatever reason, there's some sell side pressure, and the stock just doesn't get above this price. That's called resistance. On the other side, there's these things called support, okay? So support is going to be these different levels where we don't want to drop below, okay? A lot of people came in, they bought higher up here, and then when things start to sell, they don't want to sell for a loss, so they'll buy back more in, and that'll get the price going back up, okay? So that's resistance and support. All right, so when you're doing this, looking at resistance and support, don't get too caught up in these couple day movements or these week-long movements. You need to take a step back. So these smaller movements, that's considered more micro, and we want to take a look at the macro, the bigger picture. So all the way back here, March 9th, okay, we came up to this price point of $19.30. So we just went 1, 2, 2.5 months, and now that we're in July, all of a sudden that price point matters again. So we finally got back up here, got to the line of resistance, and instead of bouncing down like we couldn't get over it the first time, we actually broke through. And once you break through, you're kind of just riding the wave. So a lot of people will sell enough to cover their initial investment and just kind of let it ride. Other people just see how far we can go. And now we find this new point. This is now new resistance, 33.67, 33.70, somewhere around there. What we can do is look back to this other past resistance to be future support, and that's exactly what happened. We got back down to that $19.30, just what we saw in March, and now instead of couldn't breaking through that, now we can't break through it again, but in a positive way. Now it's acting as support for us. So we're working with the bounce. Okay, so moving on, another tool you can use is called the RSI. It's the Relative Strength Index. Okay, we call this an indicator. So just so you can see, I don't even think this is all of them, but this is just me scrolling down. These are all the different indicators you can use, just different little tools. Okay, there's probably like 100 of them. And every one is a little bit different. Some of them are just variations, like there's a couple different RSI variations. The MACD is pretty popular. You can look at the different moving averages. Those are popular. You have the Bollinger Bands and Fibonacci retracement. There's so many. But today we're just going to stick with the RSI because it's pretty easy and also pretty effective. We're going to hop on to Investopedia.com because they can explain everything probably a little better than I can. But basically what the RSI is it's a momentum indicator, okay? So momentum of the stock price. Are more people buying or are more people selling? So this is a tool we can use to kind of judge whether we should get in or whether we should not get in. Because if more people are selling, that's just going to drive the price lower and lower. And then at that point, we're just waiting for a good entry price so we can get back in and ride the wave of the momentum going back up. Okay? So what it is it was actually created in 1978. People still use it to this day. Okay? So it's obviously got a little bit of merit to it. But it's a range. It's just kind of a scale from 0 to 100. And when it gets to a certain point, you can tell that it's kind of overbought. So too many people are buying it right now. We're expecting a drop. Or it's too low. Too many people are selling. We're expecting it to go up. And those numbers are 70 and 30. So I'm going to go back to the other one in a sec. But if it gets over 70, that means too many people are buying right now. It's either going parabolic and we're just riding this crazy wave. But you can expect it to go down pretty shortly after that. The exact opposite for when it's below 30. Too many people are selling right now. For whatever reason, some bad news came out or whatever the case. But it's pretty oversold. The actual stock has more value than what it's at. So more people are going to buy back in to get it up to its actual value that it should be. And this is what it looks like. Okay. So if you want to check it out, you're going to go to indicators. Just scroll all the way down here to, so not RSI strategy, but relative strength index, okay? Just go ahead and click that. It'll pop up down here on the bottom. You can make it as big or as little as you choose, just something you can read. But you can see our little range here. So this bottom line is going to be 0 all the way up to 100. And then it highlights this 30 to 70 range, kind of the middle range that it should be, so it's easy to see as soon as it pops out, okay? So I'm going to shrink this back down so we can actually look at the chart as well. But let's just see how it follows the price. So we pop back up. Actually, we'll even look at this one right here. We popped up a little bit, looking a little overbought. Boom, instantly went back down a little bit, back into the purple. And then sure enough, we shot back over, okay? And then we drop back down. So momentum is, you can literally follow it down here, that it's like, it's dropping, it's dropping, it's dropping, gets to the range. Nice, right here in the middle, somewhere about 49.50, that's considered stable, so you don't really know if it's going up or down from there. You kind of got to wait for the next candle to see what's going to happen. So it's not a great time to buy when it's in the middle, because it's not really telling you anything, it's completely neutral. So then we wait for the next candle, boom, we see that it dropped. Now it's at the 30 or below. You can tell it's a little oversold, so a lot of people are going to try and get it back up to the price where it's supposed to be, or where people think it should be, okay? So there you go, May 27th, and then you can just ride the RSI wave, ride it all the way from the very bottom all the way to the top. So you could have bought down here at $12.30, and then sold where we hit the top of the 70, and then you could have sold at 15.08, all right? And then again, you just keep following the waves, downward trend, another downward trend, and then we're definitely oversold. We're at 22, okay? So you could have bought in here at $11.25 and rode the wave, sold at $13.50, or if you were trying to keep it in the macro, okay, You could have sold right here, waited for it to go back down, and here we are kind of in the middle again. You don't know what's going to happen, so you wait for the next candle. Boom, we're going back up. We still got plenty of room, so we ride this wave. So you could have bought back in, even if you didn't buy this candle right here, you could have bought this candle, 1258, and rode it all the way up until right here. We're getting here. So you don't want to just sell right away just because we're at 70. You're going to wait for the next candle, okay? We're right here. Boom, the next candle's green. So you're going to stay in, okay? Keep playing the game. Next candle, green. Boom. Keep playing the game. Next candle, green. And then red, okay? So you don't have to sell the first second that you see red. You're going to wait for the next candle to see. That next candle is going to be your validation. So if this second candle right here was red, that's the time to sell. But the next candle was green. So you would stay in. Even though we're over the RSI, you're paying attention to the candles, okay? And each of these is 1 hour long. So you kind of have to be paying attention to it if you're riding it at the top. You can just set a stop loss or like a market sell and be like, okay, if it gets over $22, just sell it automatically. I don't have time to pay attention to this all day. You just set a stop, a market order, and as soon as it gets over $22 or whatever price you set, it'll sell automatically. You don't have to pay attention. But while it's over this is like its danger zone. And so you don't want to be holding on because like in a flash, you can get one of these red candles. It went from $31.76 all the way down to $24 in an hour, okay? But what's happening here is you're just seeing this downward trend on the RSI, okay? That's basically foreshadowing what's about to happen. And sure enough, we went from a top of 33.53 to a low of 18.44. That's like a 50% drop almost, okay? And here we are again. We're at this neutral point. It's a little low, so you're just going to have to wait and see for the next day, the next candle. If it's a red candle, it's probably going to sell and drop a little bit more. But if it drops a little bit more, that's going to start giving you a chance to, it's going to give you another buying opportunity, basically. All right? All right, guys, just a quick summary. Use the candlesticks. Don't use the line charts anymore. Use the candlesticks to light the way to profits. You like that? Like what I did there? You're going to want to find past support and resistance lines. This is just going to give you an idea of possible entry and exit points. Next, go ahead and turn on the RSI. TradingView is that website that I was on. It gives you a nice, clear, and easy-to-use chart. The RSI is free, and it's really easy to put on. So it'll just tell you from that macro perspective, you know, when we take a step back, do things look a little overbought or a little oversold? And lastly, just don't get greedy. So day traders, which are like mostly not successful, I promise you most day traders lose money, but the successful ones hope to make about 1 to 3% a day. So if you're trading 200, 250 days a year, you can tell how that's going to add up. Long-term holds, so if you're just buying stocks in the S&P 500 and you hold them for forever, maybe not this year because we're potentially going to go into a recession or, you know, the effect that COVID has had on everything. Typically, though, you'll make anywhere from 7 to 12% a year. So just think of it like 10% a year. And that's really good, too. It's a little bit safer than day trading because you're less chance for you to lose all your money. But swing traders are somewhere in the middle. And so if you use the RSI, that's going to be like a swing trade strategy. So take your profits. That's just locking in money. And 1% is 1%. $100 is $100. That's just money you didn't have before. So just don't get greedy. Get out while you can. And just lock it in. So that's all I got for today, guys. Thank you so much for watching. Let me know in the comments if there's anything else you'd like to see, and I'll see you next time.